Hello and welcome to our webinar on institutional investors and emerging and frontier markets. We are joined today by two EMEA members. Mr. Adam Chopin is an analyst of research and investment strategy at the FIS Group, a $4.5 billion asset management firm which combines emerging manager investments and macro tactical strategies. Mr. Bob Bukowski works for Alpha Consulting. Bob founded Alpha Consulting in 1989 and has worked with clients ranging from $1 million to over $1 billion in assets. He has worked in the financial services industry for over 30 years. Today's webinar will be coordinated by EMEA founder and managing director, Mr. Nate Sapaya.
Okay, fantastic. So let's get started with I've put up the questions we're going to discuss over the course of the next hour, but let's kind of take a historical look, from both of your perspectives, because you have both very different perspectives. Let's say in a 5 or 10 year time horizon, it's up to you guys, how have you seen the change of perception from the point of view of institutional investors regarding emerging or frontier markets? What did they ask 5 years ago, or what didn't they ask, to what they're asking today? What were they interested in or not interested in 5 or 10 years ago compared to what they're interested in today? So Bob, why don't you start out with what you've seen in terms of your clients or your advice in the change or maintenance of a perception regarding developing markets?
Yeah, and if I can go back even further, I would say I started Alpha back in 1986. 1989. And back then, I was just trying to convince people to diversify by investing internationally. They typically had a domestic portfolio of large cap and some bonds, and so once you got to the small cap and maybe even mid, which really didn't exist then, you pushed for international. And so the EM and frontier didn't really exist at all. And I think what's happened over time is the world has gotten a lot smaller. Travel has become a lot easier, and people see a lot more, whether it's on the computer or on the television. So they're much more interested about what's happening around the world, and I think it's been an easier sell, if you will, today to convince people that frontier and emerging offer real growth. So I think they're all very interested in it.
Okay. Have you seen kind of more questions come up? From my point of view, if you go back 5 years, people were interested in Africa but not asking how to allocate. You fast forward to 2016, they're starting to ask more kind of buying questions, if you will. Have you seen your clients been asking, Bob, why are we not in China, or why are we not in Africa, so on and so forth? Have you seen the interest?
I guess we were, maybe I'm a bit like Adam, we were a little more proactive in that we started the conversation.
Okay.
And we carry on the conversation. So we bring it up regularly as we discuss markets. I mean, our client service model is kind of see every client every quarter. So we're in their offices talking to them about what's happening around the world all the time. And so it is something that's on their mind now, today, all the time.
Okay. Adam, what has been your experience in the changing perception of emerging or frontier markets from the point of view of institutional investors?
I think there's definitely been a breakdown in the perception that they are a monolith, and
okay.
And I think that at least on the emerging market side, and I think that, but I don't think that has actually changed the way that the biggest institutions are allocating to them yet. I think that will in time, but I don't think that it's done so quite yet. For the most part, most large institutions still allocate to them as a single monolithic asset class,
okay.
Looking to either active or passive managers to be able to manage their largest allocations. You do see some, in sort of the mid-size institutions. Obviously, there was a lot of flow many years ago into the Tarpons and other Brazil managers of the world for Latin America, and there's obviously a lot of money that is in Asia or Asia ex-Japan or China specific. But from the biggest American institutions, certainly the ones that we work with, which are our core clients, you don't see a lot of that. And
okay.
If you do, it's often on the alternative side and not so much on the long-only side. As the liquidity and the size, because there's a numbers game that you have to play for these, for the bureaucracy to be able to make these changes in allocation structure, and it's fairly simple, even though it's stupid, and that is because in order to justify a single allocation, you've got to be able to throw around anywhere from $200 to $500 million, and you've got to be able to do that without being more than usually 25% of the product, and usually product, but sometimes only firm AUM. So do the math backwards and think about how much money can you run if you're running
right.
Something that's not global equities, or not global emerging markets, and so it creates this market structure whereby you can't think anything beyond the biggest box, and so either the box has to get bigger, the underlying structure, allocative structure, has to change, or individual parts of the sub box have to change. The first two are not changing. The box is actually getting smaller, and a market cap basis of the emerging markets universe as it's sold off the past couple of years. The underlying allocative structure of the investors is definitely not going to change. The incentives of job risk and underlying structure are going to be there, I think, in more or less perpetuity, at least until the Americans adopt the Canadian model of trying to actually pay for outperformance, which don't hold your breath.
Fair.
And then but the third thing is change, right? Is specifically China. China is now big enough to justify its own allocation, and so this could be the first, and that's only once the A shares really get included and become truly investable, which I think we'll see over the next couple of years, and that could actually have some far-reaching effects for the structure of institutional allocations to the space, in that they bifurcate global emerging market allocations and China allocations.
Okay.
But that would, I think, be the first big change in their allocative structure to be on the lookout for.
So to take care of that size requirement, that's the required allocation, would you agree that kind of most institutional allocations are going to larger vehicles, kind of more global macro or global frontier, as opposed to direct investments in, say, Argentina, Vietnam, wherever, because of the lack of scale or size?
Yes. I mean, so at least on the liquid equity side, right? So because liquid equity side, they have these rules about how much, what percentage of product and things like that they can be in. They will, on the alternative or private equity side, they will make investments into, and again, talking about the largest institutions, they will make investments into those direct investments or a liquid side, but they look at it, it's structured differently because it's out of their other bucket. And as we've seen with folks like CalPERS, there's other drama that happens, that's been happening on that side of the shop, or that side of their business, with fees and fee compression and problems with allocation size and structure as well. So, but that's, I think, but there's a huge, in the U.S. especially, there's a huge swath of investors. Obviously, the most famous, Yale, Princeton, so on, the Ivies, and other institutions like Templeton Foundation, which are famous for being quite a bit more nimble. But so I'm really trying to speak here to the largest institutional investors in the marketplace.
Bob, what have you seen on your end in terms of problems in investing in emerging markets, or as Adam kind of said, boxes that aren't ticked in terms of your clients allocating in emerging markets? What have held your clients or your contacts back from emerging markets, and what's kind of pushed them forward?
That's a great question. I have to think about that. I think that in the U.S., while Adam has an interesting structure in that they're all separate account managers that they're pulling together for their clients, our difficulty is finding the structure that our clients feel comfortable with. So they're more comfortable first with some kind of an LP structure that might be U.S. domiciled. They're not as comfortable if it's domiciled somewhere else in the world. And there are more emerging markets managers and frontier managers outside the U.S. than inside the U.S.
Of course.
And so that's our break, if you will, is finding managers that the client feels comfortable investing with based on it operationally. And so we spend time in London talking to people. We spend time overseas talking to these managers and looking at their due diligence and their compliance, their government compliance, and we want to find out what it is they have to do to comply. And so that's really our difficulty. There needs to be more product in the U.S. is the reality. To make it easy for U.S. investors. I think if it was available, they would do it. There's just very little product here.
Sure.
Hey, Bob, if I can interject, Nate, I'm
Please.
curious. What's the opinion, or have you seen an evolving opinion of wanting onshore U.S. vehicles versus offshore tax-advantaged U.S. vehicles? I mean, obviously the thing du jour 10 years ago was a Cayman fund, but with FATCA and everything like that, has that changed the preferences of your client set, or I mean, how have you seen that evolution to get to where it is today? Is that where your client set has always been, or is this something that's changed to it?
I would say our client set has always been there. Everyone would, rather invest with someone locally than in some, faraway place. So, as I said early on, and when we tried to convince people to invest internationally, today we're trying to convince people to invest in a firm that's domiciled in another country somewhere, and that's, I guess, for the typical non-taxable client, the offshore vehicle is nothing different because we also have hedge exposure, so they've been there before, they've been offshore, and so it's not as big a problem as as I might make it out to be.
Okay. A quick question like that I was going to ask kind of later on, and I'll get to you, Adam, in a second. But since Bob kind of brought it up with his investors or his clients preferring U.S. domiciled assets, is there any kind of correlation with that? What we call it, a kind of headline risk. They read, New York Times, Wall Street Journal, whatever, and those things cover majority the bad things that happen in emerging markets: Boko Haram, tsunamis, Ebola, whatever. Are your clients, have they become tentative because of that, or is it more just they prefer being domiciled in the U.S. where they know everything works fairly smoothly?
That's a fair question. We have not really had the issue, but once, and it was even that was a private foundation. Typically, if it's a private foundation, they're not as concerned about it. If it's a public foundation, they're a little more concerned, and certainly if it's a retirement plan, they're concerned. So.
Sure.
The headline risk is part of the, part of the process that they have to get over. Where are we going with this money? So.
Sure. Adam, from your end, do you get questions like, I don't want to go here because there was an isolated incident of violence or disease or whatever that kind of taints their mind to a region or a sector?
In my experience, those are excuses, not reasons. You have to. It's hard to appreciate how bureaucratic a large pension fund is, where compensation is not structured on outperformance. And so the thing that you don't want to do is you don't want to stick your neck out. But sticking your neck out doesn't necessarily mean affiliation with. I mean, they obviously don't want headline risk managers, right? That's probably the most, one of the most important things. But if everybody else has, if all your peers or competitors or however you define your opportunity set has exposure to all the same headline risk, you're not as averse to it. But if you are sticking your neck out in a way that where you are doing something that's different, right, than the rest of your peer set in a bureaucratic mindset, then you will be averse to it, right? So so specifically, they're not averse to China headline risk because everybody's already in China.
Sure.
But they are averse to headline risk in Iraq where nobody's in Iraq,
right?
So it's just a question of what the market already makes acceptable and where the peer group already is. So.
Okay.
So yes, we will get the same excuses from people that about they don't want frontier markets, crazy places or whatever. But really, they would be there if it was easy to do so.
Okay.
And so I don't think that they're real reasons, because the reality is, if you want to go to a place that doesn't have a government for 2 years, you can cite Cote d'Ivoire, but you can also cite Belgium. And nobody's not in Belgium, so it's just a relative to the opportunity set.
Fair.
In my opinion.
Just to add on to that, if we're talking about institutions feeling more at ease to move into these markets if there's a critical mass, would you say there's any kind of advantage to being a first mover? So if you're an institution, you move into Myanmar first. Is there any advantage to that, or do the institutions kind of have it right with the reticence in waiting for bigger funds or known names to move in there, then following their lead?
So I think again, it defines on how you defend, or depends on how you define advantage. If you mean it in an actual capitalistic better returns, that's absolutely an advantage to being early. But if you mean it in the way that someone who's trying to protect their job means it, then no,
Fair.
right? Because the upside versus downside risk is not. These are asynchronous, right? Because if you are early, you have substantially more downside risk than you have upside risk, right? Because you do not get compensated for the higher performance necessarily, but you can lose your job for sticking your neck out. So it's
and if I can just add a quick story, we've looked at a couple funds that were very early in a lot of places, and as we looked at the things they were doing, the underlying investments, about a third of what they were doing would be considered illegal in the U.S. So the headline risk was just too great. We were just like, no way, we're going to stay away from that.
Fair enough. Would you, Bob? Would you agree?
I think that you can make more money, and we should be more early. But again, it's just you have to be cognizant of, and there's such a thing as too early. So maybe what Bob is describing is probably just too early, because there's early and there's too early, right? So Myanmar might be a case of where you can be early, but it's not actually too early. Whereas people looking at Iran right now might be a little bit too early. To give you an example.
Bob, would you agree with Adam on the kind of critical mass point, like from your experience that, once there's a critical mass in a region, like 5 years ago in Brazil, currently in China, Mexico, it's easier to convince people to look at these markets, or they're more acceptable than, say, the frontiers where they're, somewhat illegal, or there's not a critical mass of investors?
Absolutely. The critical mass point is a great point. Once people understand, they're more willing to go in, and that whole headline risk kind of goes away.
Okay. Kind of narrowing it down from, why people or why institutions are looking at these regions. In terms of, Adam, you mentioned, there's different buckets for different assets and types. Have you seen, are most people looking at, plain long only, long short, more alternatives? I mean, the end of the commodity super cycle, are people still looking at agriculture, real estate, private equity? Adam, if you want to start with kind of in terms of what people are looking for in terms of the actual asset classes when they come to Frontier, because personally, I think you can get, better returns if you're looking at private equity over equity, where sometimes these equity markets are quite thin or there's low liquidity. Obviously, the private equity is the play, or hard assets. What do you see institutions looking at in terms of the actual type of asset they're allocating to?
I think that's for big institutions, it's mostly fairly vanilla.
Okay.
So they're looking, for the most part at listed equities and fixed income, and they're perfectly happy with their multi-asset or global exposure private equity fund that they're invested in, to take a couple of flyers in Colombia or Nigeria or Zambia or wherever. But if that's like 50% of the portfolio, that's probably not where their comfort zone is. So I think that certainly a lot of Africa private equity funds raised a lot of money over the past several years. So there's people definitely putting money in there, but is it going into even within that, there's shades of gray in terms of what is pretty recognized to be pretty safe, companies that have been around a long time, management buyouts at modest upside but limited downside, versus taking on greenfield investments in Pakistan or something, where I don't think that the appetite is just going to be there for a lot of big institutions. So it's while yes, you can get more returns for taking more risk, as I mentioned before, the upside downside for a large institution is not measured the same way.
Okay. We have a question from the audience to both of you. The question reads, given the size of mid-large institutions in terms of AUM and subsequent ticket sizes, assuming 1% to 2% of global equity allocations to a global frontier market equity fund, why is it that most institutions allocate to dangerously large mutual funds and overlook small hedge funds structured long only, with little assets that could actually handle large allocations? Is there a minimum fund threshold size to win an allocation, or is it something else?
Yeah, the answer was in the question. So because if again, you've got to depending on the size of the underlying fund, you have to be able to write a ticket of X amount of money, right? I've literally been told by a major, and we can allocate because of our fund-to-fund structure. We can put a lot more money to work, and this is sort of why we do what we do with smaller managers that don't bump up against these capacity issues. But I've literally been told face to face by a major pension fund in the United States that Frontier Markets doesn't, quote, move her needle, because she has to be able to put in to work, at least she has to be able to write a check for at least $500 million. And once you do that, you flooded a fund, right? Because in frontier markets and long-only frontier markets listed equities, that's about the threshold at which it makes sense to run a fund. And so unless you're going to own the fund as that investor, right? You can't put money in,
Sure.
Unless Mark Mobius comes to you and promises you that he can get, that he can run $4 billion in frontier markets, and isn't gonna, and he can still stay liquid. And you say, well, God, Mark Mobius is a genius. He can do it better than anybody else, and so he does until he doesn't, right? And so so that's sort of the game. And that's exactly why you see large funds get large in frontier market space, because there's herding and there's safety in numbers by institutions, and it solves their allocative problem. Somehow they perceive that the rules of the game are different if you're Morgan Stanley or Wasatch or Templeton or whoever than if you're some boutique hedge fund.
Okay. Bob, on that question, do you see kind of a threshold to investment, or are your clients a little more flexible, or how do you see, a fund reaching out to you and ticking the right boxes?
Well, there's kind of 2 points to that question, I think, and one was, to me, making a 1% allocation to anything doesn't make any sense at all. It doesn't move the needle ever. It doesn't matter what size your portfolio. So that you have to make a meaningful allocation. And if it starts at 2 or 3, we think it should go to 5 to really have an impact, and that's really what we push for every day, is to move the needle on the frontier and emerging. Emerging a lot easier, but on the frontier especially, can we get it up to 5%, and how do we get it there? And because our clients are smaller, we can access smaller funds, and we're not as concerned about a fund with smaller asset size. In fact, we're kind of searching those out.
Okay.
Who has $100 million in assets? Who's been running it successfully? Can we get in operationally? Do they have the due diligence that allows us to use the fund? So we're not looking for the Templetons of the world to invest our money. I like to read Mark Mobius's stuff, but no, we don't invest.
Fair enough. And then Bob, because we kind of I interrupt you guys with this question from the audience, but Bob, if you want to kind of follow up where Adam left off on the last question I posed regarding the kind of assets your people are looking at, do they have any interest in private equity, or is it too illiquid? Are they looking at hard assets, or also again too illiquid? They're looking for plain vanilla U.S.-based, global macro, or what exact kind of assets are your clients looking at or interested in?
We started really with the most liquid part of the market that we could access. I mean, that's a relative term, right? And we have moved from there to some of the long-short managers in the frontier space. Our clients are not looking at the private equity. They're not looking at any of the those kind of deals right now. Although it seems like I get 20 emails a day on things that are coming up. So. We have just not moved in that direction.
Okay.
We're into liquidity in general.
Fair enough. So we're going to move on from actual assets to kind of regionally based. I mean, this is going to be an interesting discussion as Adam is more on the analytical number side, and Bob is more on the anecdotal side. But looking at regions of which institutions are interested or comfortable or getting more comfortable or maybe comfortable in years to come. Adam, why don't you start with, like you mentioned the critical mass of China. I mentioned, Brazil 5 years ago, so on and so forth. In 2016, where do you see the critical mass is currently at for institutions to want to invest or might be going? But what regions do you see institutions interested in? And also from your analytical background, where do you think are regions that you think are interesting but they're not there yet?
Oh, the last question I'm more prepared to answer than the former.
Okay.
All of the former should theoretically be easier. I mean, the institutions are willing to be in anything that their peer set is in, right? So
Okay.
anything that's in the index that's sort of understood, they're willing to be in. Are they excited about it, right? Are they, so that means they're willing to be in Brazil and Chile or Colombia. Does that mean they're excited about it? I think that's an overstatement. Obviously we've seen a lot of pullout from Latin America assets over the past several years. Latin America is probably at or near a bottom right now, and obviously we've seen a little bit of a bounce, although I think it's a bit of a dead cat bounce, in my opinion. But I think that there's India seems to be the one overweight consensus trade in global emerging markets of recent, but it was such an overweight consensus trade that it sort of sold down a little bit. But it's probably there's probably a good reason for it to be bullish in the medium term. China is this sort of enigma. People don't really think that it's hard for people to understand because it's so big and complicated. But in reality, it's not any harder to understand than the United States. It's just a very big market, and so it's so relevant that everybody has an opinion, even if they don't have any information.
Okay.
So yeah. I mean, I don't know if there's any place though. I hear institutional investors saying they're really excited about it.
Okay.
There's lots of places that they're interested in, and there's lots of places that they're willing to be in if their managers tell them that that's the place to be, or their consultants tell them that that's the place to be. But of the major markets, I don't think there's a lot of euphoria about any of these places like you would have sensed, even just 3, but certainly 5 or 6 years ago. As to our opinions on where you should be that the market is not pricing in, we publish quarterly and annual outlooks on where we put ourselves on record for what those opinions are. And so this year on a global basis, we're the most bullish about Japan, which means we've heretofore been loud wrong, but we're still very, very bullish on Japan. We think the fundamentals are very good. Obviously, it's not an emerging market call, but we think that's a much better place to be than almost any other place in the world. But within emerging and frontier markets, I would say in no particular order, we're quite bullish on Eastern Europe, ex-Russia, which is an oil call. So get your oil call right, and then decide about Russia. But we're very bullish on sort of the less liquid parts of Eastern Europe, in particular frontier Europe, like Romania and some of the more forgotten markets that are more small and illiquid and deeply neglected. We're fairly bullish on Argentina, Vietnam, India, and then certain segments of China. Although we think that still there's two. This is probably the most obvious call on the planet, but still people seem to hem and haw about it. But there's quite obviously, quite apparently, 2 economies in China at this moment that are struggling to compete for political, structure and favor, and so trying to deal with that old industrial export sort of focused or jobs focused economy is probably a better way to put it, and the new sort of service consumer economy, and we're very bullish on the latter and recognize that the former is essentially going through a political restructuring.
Sure. Bob, before we get to you, one more thing for Adam. When you mentioned, bullish on Vietnam, frontier Europe, what are the main, kind of indicators or reasons that, you are bullish on the regions? Is it just kind of underpriced assets?
Yeah.
Is it just it's been neglected and undercapitalized by international markets? What would what ticks your box and you're like, this is somewhere we got to look at?
Great question. So it depends on each one. So frontier Europe, it's less liquid, been neglected, undervalued, and there's a catalyst of what we think is essentially the spillover from European equities that will happen over the next year or 2 years. I mean, it's been neglected for a very long time, and this is Eastern Europe, or emerging and frontier Eastern Europe. So specifically, pretty much everything except for Russia and Poland. Like Poland, we're sort of neutral on. Maybe it's it's harder to read because of the political stuff going on there, but so Hungary, Romania, Czech, and the rest of frontier Europe, so the Baltics and Balkans essentially. Turkey also is sort of its own enigma, but or got its own separate issues rather that are hard to price into the same bucket. But we think that there's a lot of there's positive contagion effects from what we think will be ultimately positive liquidity happening in Europe and flowing into to equities. These companies do have, I think they're in a good spot in the earnings cycle, so there's money to be made there, and the valuations are pretty cheap, and they're cheap on low liquidity, which means that there's a lot more ability for it to re-rate upwards than downwards, because we think that most of the flow out has already happened. Vietnam has been good economically for a long time and very stable, and the market hasn't moved anything. So you can't, Vietnam is like the poster child for, if you make the call based on your GDP expectations, take a back seat. Because although I guess probably China realistically is the poster child, where economy grew for 10% a year for 20 years, and, and the market was flat. So, but Vietnam in a smaller case, or more recent case, in the frontier space. And but we think that there's a couple of underlying things that are happening. One, it's just as attractive as it has been, but everything else is less attractive, right? So its relative attractiveness has improved by virtue of everything else being not so attractive.
Sure.
That helps.
Okay.
Because in a world of relative opportunities, if you're an asset allocator, you're looking for the best thing to put your money into. You're not looking for all the great things to put money into, right?
Sure.
So don't let the best be the enemy of the good, right? So there's a couple of underlying structural things that I think will change, are good catalysts in Vietnam, specifically the change in foreign ownership regulations, which will be implemented over the course of this year, which will allow most of the companies to raise their foreign ownership limits from 49% to whatever they decide to set it at. That has to be implemented on a company-by-company basis in the listed equities, and so that will take place over the course of this year, maybe this year and next year, as they sort of sort things out, and the re-rating will happen, I think, not a major re-rating, but a meaningful re-rating concomitant with that. Also, they just changed their rules for gaining custody. Vietnam is one of the most persnickety and notoriously difficult companies or markets in which to actually get custody for your funds, and so that drives a lot of funds and institutions out of the market, or out from even bothering to get into the market on a direct basis. And so that the time has reportedly been cut in half as of changes that happened at the late end of last year, and so we think that these micro catalysts, along with the sort of relative attractiveness of the market coinciding at the right time, makes it a fairly attractive call.
Okay. Bob, let's, in terms of, where rather than what you see, from your point of view, either where have you been where you're like, I like this place, I want to talk to my clients about it, or where have you seen they've been interested in regionally? What places are you excited about?
It's really great to have Adam go first because he has all the facts and figures. And I think if you look at, the Standard Chartered has the 7% club, and it's Vietnam, India, Bangladesh, Ethiopia, Tanzania, Uganda, Mozambique. And I have been to a couple of those countries, but if you just think about Vietnam and Bangladesh at 6 or 7%, that means their economies double in the next dozen years, 10 to 12 years.
Yep.
And countries like Bangladesh is a net energy importer. So for all the fear of the emerging and frontier of this oil pricing and prices going down, not all emerging and frontier countries are dependent on oil exports. So if you're an oil importer, that makes you more productive, lowers your cost of labor. Why wouldn't you go there? I think Bangladesh today has one of the lowest hourly rates in the world. So if you're going to build any kind of major manufacturing facility, you're going to do it there versus just about any other country. We do not try to allocate to countries. We try to find good managers that can allocate, like Adam, to countries. So
sure.
I don't have anything more specific than that to say, except that we think that just the general numbers of stronger growth throughout the EM and frontier versus the developed market, it just makes sense to get real growth from those countries.
Sure. Adam, what is your perspective on Bangladesh as Bob makes a good pitch?
It definitely it's economically in a really good place, but it's a little bit pricey depending on your perspective. But so it's harder for us to make a very clear call on that because we don't see a reason why in the short term. But long term, I totally agree with Bob. Right? It's as long as the economy doesn't, as long as the political economy doesn't go down the tank, which these kinds of places, especially with very volatile politics, has propensities to go in these cycles. But otherwise, it does seem to be on a very good trajectory. But when we make our country calls, we're looking at a 6 to 12 month horizon, and I just didn't see a catalyst there on a very near term, given what are already fairly reasonable, if not lofty, relative to the universe valuations to see something in the very near term. But I certainly would be happy, especially on if you can buy into some what you think are good, bottom-up stories that are less liquid and maybe less fully valued, that will benefit from those long terms. I'd love to have my own printing there, but it's hard. It's also a hard beta to play in the interim as well, because when you look at it on a for the relative opportunity basis, you're looking at a couple of banks and big name stocks that are pretty, they've been popular for a while, and so it's hard to say how that's going to outperform on a 6 to 12 month basis.
Okay, a question that just kind of occurred to me from this, most recent little discussion. Where do you value, or what is the balance of the scales when you look at kind of Bob's point of view with like solid numbers, economic growth, future progress, and future growth due to the economics, net energy importer, low cost of wages, etc. Versus Adam's point with there's been people there for a long time and it's a little pricey. From an institutional point of view. Where does that balance tip between, future growth, economic stability, good numbers versus, getting a deal or, getting underpriced assets? Adam, why don't you start with kind of where we fall in that spectrum from an institutional point of view?
So first of all, the way the FIS, we do it at our firm, it's very easy because we let our managers make the bottom-up calls and we make the top-down calls, and the two can be done on completely different horizons. Right? We hire managers that have, for the most part, sort of 2 to 5 year views on companies, and they make that longer term call, and we expect them to do that bottom-up due diligence on a case-by-case basis. We do have some managers that are a little higher turnover, and they'll make a little more top-down inflected calls, but we'll have a mix of those sorts of styles. And so, if we trust the manager, if they're in, whether it's, Bangladesh or France or wherever, we trust them to make those calls on the bottom-up basis. When we implement our macro tactical overlay, though, in which we run in-house, we're making that sort of 6 to 12 month call. So it's just run on the two different strategies that are done to pair each other, not to compete with each other. So we're a little bit unique in that regard relative to what most what most investors do, because most investors. Big institutional investors like our clients, while they may take some, they may do a little bit of, sort of macro overlay trading on their accounts as well. You can, at the size that they are, you can only do that in the most liquid places, to be able to really make that work. So, Bangladesh is never going to enter the discussion, for example. They're looking at essentially whether or not they're going to overweight, fixed income, or maybe it's something as narrow as China or Latin America. That's about as narrow as they can get if you're a very large institution and you're making a tactical bet. So, and there's really, I don't think, a ton of that happens. There's a fair amount, but there's not a ton of that happens direct from the institutions. Obviously, they are in hedge funds and they are in other managers that will do that on their behalf, but then they're making those calls at different allocative levels, and so that changes the structure of decision making.
Okay, Bob, you already kind of talked on this, but from your client's point of view, stability versus volatility, or stability in terms of the numbers you were talking about, Bangladesh versus the underpriced assets or somewhere where there's not a critical mass. Are your clients leaning towards the stability side?
I would say they are indifferent at some point.
Okay.
The reason I say that is if you look at South America last year, two of the best countries were Venezuela and Argentina, and they both have difficult economic and political issues. Sure. Yet their markets did very well. And so to some extent, we just want to capture some of that growth. So I think to this point, we have not concerned ourselves with it. We leave that decision up to the manager, the underlying manager.
Okay. We're going to kind of zoom out a little bit to a more macro discussion, but just as they are different places, and maybe one day they'll be homogenous. But in your guys' perspective, when you're approaching institutions, they're coming to you. Where is the divide, or what are people? How do people differentiate between frontier and emerging? Are they just kind of looking at it as developed and undeveloped? Are frontier super scary and emerging are just China and Russia? What is the perception of these two kind of categories, emerging vis-a-vis frontier? Bob, why don't you start?
Um, just based on how we tend to structure portfolios and monitor portfolios, we tend to use benchmarks. So we try to be very specific about what it will and won't include. And so, I think it's a clear demarcation of what is emerging and what is frontier. And we typically have a separate emerging manager from a frontier manager. So I think it's differentiated pretty well just using the indices out there. I don't know how else to answer that question.
Okay, fair enough. Adam, from your perspective, do you see that like the perception of institutions when looking at emerging or frontier is kind of index based? They see S&P, or they see MSCI, or see whatever, and they're like, all right, this is frontier, this is emerging, or are they confused on the topic? Is one scarier or better than the other? How do you see the perception of those two categories or buckets, if you will?
Yeah, I mean, in terms of perception, I don't think that and perception of the markets, I don't think that actually they view them as much different. But when it comes to actually being able to pull the trigger on an allocative decision, there is a bright line: liquidity and scalability. Right?
Sure.
You cannot, as I mentioned several times, you just cannot pull the trigger if you cannot allocate enough money, and you cannot allocate enough money if it's not scalable or liquid enough, right? So, or large enough, right? So, and so that's sort of where that. So, what that has meant heretofore is that most frontier markets are still either off limits or at best a flyer for a large institution to make a bet on. And if they do make a bet on it, they're confined to investing in one of the, 5 or 6 largest managers in the universe because they're already so large as to not pose some sort of perceived redemption risk, even though they'll probably still allocate to them on a separate account, which makes the whole thing silly, but that's a different story. So but in terms of actually when you actually sit down with the investment staff and talk about the individual markets, they understand them relatively well, and they understand, insofar as they understand any, right, insofar as they have a view on Brazil or China at all or whatever, they'll understand the nuances between, Argentina and Brazil, or South Africa and Zambia, but when it comes to actually making a decision about what they can actually do with their fund, moving the kind of money around they have to be able to move, the scalability and liquidity are bright lines.
Okay. Just a follow-up on that. Looking forward, if these institutions want to access frontier emerging market returns, do you think there will be a kind of paradigm shift where they'll be able to allocate less, or do you think it's just a matter of waiting for funds to get big enough to accept the tickets they want to write?
Well, for emerging, there's no problems. There's plenty of
Sure.
they can move enough money around in emerging markets. And insofar as frontier are, what they like, I mean, they do like funds to be able to solve their problems of allocation by probably investing in some frontier markets on the side of emerging. But they want to place that bet on the manager, and they're not going to necessarily expand the benchmark, or even if they do, they expand it to something that's effectively meaningless for making a large allocative bet. But so I don't. But in terms of so they still will treat the two asset classes differently. But again, it's not because of somehow they really believe that Nigeria and South Africa have this bright line between them, other than scalability and liquidity. And you could say the same about Vietnam and Malaysia or wherever else these fault lines happen around the world.
Okay. Bob, on your side, do you see your clients, willing to be more flexible in terms of, if they find a really good manager in an interesting place with good numbers, good background, track record, etc., would they be willing to allocate less, or would they more likely to wait till that fund grows to a size they're comfortable with?
We have always been more apt to hire managers with less money.
Okay.
Frank, we think too much money is always a burden.
Fair enough. Okay.
Yeah, we completely agree. By the way, so, and I don't want to. When I'm representing the views of institutional investors, and I describe myself or ourselves as institutional investors, we at FNFX are designed to try and be the bridge between what we see as the ridiculous and what we believe is the intelligent.
Okay.
And so we, for those prospective managers listening in or whatever, that if you run a small fund in some place in the world and haven't talked to me, and you run long only and you're employee owned, get in touch with me.
Yeah.
And we'll probably say no, because I look at 100 funds or 100 managers to buy one. But I guarantee you I'll say no if you don't contact me. So.
Fair enough. But I do like the tagline, bridge between the ridiculous and the. But anyway, so moving forward from size to looking into, we've been talking about this and we've been kind of mentioning it in various other discussions, but let me pretend I'm a fund manager. Besides the fact I need to call Adam for him to say no to me, what are the big boxes that I can tick as a fund manager to reach out to you, Bob, or to reach out to you, Adam? If we take scale out of the equation, I have $300 million, like I'm a medium-sized fund. Is it track record? Is it interesting allocation? Is it a completely different perspective from other people in the market? Is it beating an index? What jumps out at you is like, I really want to talk to that guy. I'm going to go visit him, or I'm going to have him visit me, or I'm going to present him to my clients. Bob, why don't you start with, as you travel a lot and you meet lots of people, what jumps out at you from, what managers have you met in the past couple of years where you're like, that's the guy I want to talk to. That's someone I want to push. What were the boxes they ticked? What did they present that made you comfortable with them and excited about them?
Well, we're looking for an edge. What gives them an edge? Why are they better than the next guy? I mean, that's typically the conversation is, in the office anyway, when we meet and talk about other managers, not in front of you. What is their is it related to experience? Is it their depth of research? Is it the time horizon they invest in? So we want them to have some kind of an edge that helps them do better. We don't want to pay for someone to give us index returns. We don't buy ETFs. We want active in this space. We want managers who can provide us with some kind of value added.
Okay.
So we certainly have to like the person. And believe that they can do better than everyone else. And so, that's a tough question. It's not necessarily driven just by numbers.
Sure.
It's driven by their thought process. It's driven by how they think of the world and where they think there is opportunity. So we actually talk to, and I'm sure Adam does the same thing. I mean, we talk to all of our managers every quarter just to find out what's happening, what's going on, what are they thinking, how is it working. And they have to have certainly a sustainable business model, because there are plenty of guys that have 10 million or 20 million that we're concerned with. We don't want to invest with them because we don't think they'll ever get to scale. We don't think they'll ever build an operation. There's plenty of great money managers out there, people who can pick great stocks, but they're not good business managers.
Okay.
So they have to be both. I mean, or have someone there who can run the business. So those are kind of the basics, I guess, I would say.
And not to put you on the spot, and if nothing comes to mind, no worries. But I mean, has there been anyone you've talked to in the past couple of years, like you could give us an example of something you're like, holy moly, that's fantastic, or someone who had that kind of value add that really jumped out at you? They have their own data set, they have their own whatever. Was there something that you give us an example that you're like, this is a value add I want to be part of?
I would say it has been experience thus far.
Okay.
It has been, managers who have been in the space for longer periods of time and have demonstrated the ability to run money there. And they may not be at the same firm. They may have started a new firm, but they have been there. They have seen it. They've experienced it. Oftentimes, because I have traveled with managers to see companies, it turns out we've seen a lot of the same people, a lot of the same companies. I mean, when you think about these frontier markets, some countries only have 30 stocks. There's only so many people you're going to go see in Ghana,
of course,
or Cote d'Ivoire. So, sometimes it's just, how do we hit it off?
Okay. So, Adam,
And
Yeah,
what we don't like, I guess I'll go to the other side,
please do.
because I just had this meeting a month ago, is a young, I guess I can't even mention the university, but a young, kind of MBA master's student who's 2 or 3 years out of college, and now he's running an emerging frontier fund for a major investment house. Well, he's not even wet behind the ears. He hasn't been to any of those places. He's just looking at numbers and looking at the liquidity of the stock, saying, can I buy it? And I don't feel real comfortable with that.
Sure. Adam, from your end, what
So
kind of gets you going when you're talking to managers?
So everything Bob said, I completely agree with. I mean, and this is where I think, even though it's interesting, because even though Bob and I obviously have diametrically opposed, if you will, within the segment, client sets, and thus have different structures to deal with them, we're looking for the same thing. Because we don't have any, and arguably, and perhaps ironically, we're a little bit more open to managers at smaller AUM levels because we're just more accustomed to working with folks. I mean, I've seeded managers, and I don't take equity when we do that. We just do it based on because it's the conviction of what we're doing. I certainly seed products all the time. And again, we don't take any equity or whatever. These are exceptional circumstances, but we work with like 100 different managers, so over our $4.5 billion. So it's there's a lot of opportunities within this thing. So. And I certainly am willing to have the conversation about seeding, whether it's a long book out of someone's long short, or a frontier book out of someone's global emerging frontier, or I don't know, something like different things. But ultimately, we're looking for the exact same thing. I'm looking for something. The way I always term it is, I'm looking for different and/or better. And having that edge is the definition of better. If you can't tell me why it is, then you're leaving it to my best devices to come up with the reason. And maybe I won't. So if you don't have a reason for me why you're better, then the odds are that it's going to be harder for me to find one too.
Sure.
And so that's how you get to better. But as a multi-manager, different is just as important to me as better. Right? If you can give me the same alpha, or maybe even not even quite as much alpha, but give it to me at radically different times or in radically different ways, that's just as important to me as a multi-manager as being better. And so, because that sort of diversification, even within a long only, you can have that sort of diversification, that sort of, and whether it's style or process or whatever, that's important. And so understanding those differences in the marketplace is what, as I've counseled my managers, is what makes a marketer within a manager better than anybody else, is understanding that different and or better aspect. And so that's what we're looking for. The thing that I really get excited about, though, whether or not I work with a manager or not is a different thing, because it's all a relative opportunity set for what you allocate to in the sort of positions that Bob and I are in. But I can tell you that the meetings that I leave, and I'm excited about that manager, and even if I'm not willing to work with them, I will recommend them to a colleague, are almost invariably the managers who are super excited about what they're doing.
Sure.
They have their money in the strategy. This is their passion. This is what they love. This is and you can feel the infectious excitement of what they do in the way they talk about it. It's not a hobby. It's not a lifestyle business. It's not what they did because that's how they got into it after B school and they fell into. I mean, this is somehow what they love to do, and if they could do it for free, those are the sort of managers that you love the most. And and I'll be perfectly candid, not all managers are like that, right?
Sure.
Because again, the most important thing to us is the alpha, which again, in a multi-manager strategy is different and or better, and you don't have to love what you do to have one of those things. But the ones that I'm most excited about, and the ones that I will take extra effort to try and figure out what that better is, are the ones that I think that I have the most personal confidence in, and those invariably are the ones that have the most skin in the game.
Okay, so taking you just to how Bob ended his, and you've already kind of retroactively answered them, kind of skin in the game, super excited, have an interesting value add or diversification type aspect to their fund. What are the kind of red flags that come up? As Bob mentioned, someone had never had boots on the ground anywhere, just out of business school, and was just kind of stock picking globally. What red flags you as someone you're like, yeah, I'm going to take a pass?
Yeah, for me it's lack of conviction.
Okay.
So, it's sort of like, oh yeah, we can build that for you, or we can do that for you, or yeah, we've thought that was a good idea for a long time, but we never did it because whatever, dot dot dot. So those sorts of ones, and we've worked with I have a manager that I won't name, but that has been an outstanding emerging markets manager for a very long time. One of the best track records in the universe, literally. Top decile since inception of their strategy, and they came to us several years ago, or we've sort of talked to them about starting a frontier fund as well, and they really liked the idea, but they never put their own money into it. They never had the conviction to, even though they had plenty of money, right? I understand that you can't put money into it if you don't have money, right? And so when we look at smaller managers, I sort of take that as something that we understand to look at. But if you're if you're a mid-sized manager or a big manager or whatever, as this group was, they didn't have the conviction to do to put it behind either the people that they had or in that asset class or whatever the situation was. That's a red flag. And so, if on a similar vein, if you're a long short Asia manager, and you don't think, you don't think along, I don't know, you don't think that running something ex-China or ex-Japan or whatever is a good idea, but you've never done it, but if I come along and tell you that's what I'm looking for, and you tell me, oh yeah, I'm happy to do that for you, even though I've never really tried to do it, that's not as interesting to me. If I think you've had the means to do it, right? Again,
Fair enough.
we work with a lot of smaller managers, so I'm willing to make the exception if I think it's a question of having been in a question of ability and not of desire. But if I see both and you lack the desire, then essentially it's the inverse of what I've said. What I'm really excited about.
Fair enough. We had a quick question from the audience. I believe, though I can't confirm, it's based on one of the charts we had in the deck of Frontier Market AUM, which has Global Frontier at 44%, EMEA at 30%, Asia at 19%, Frontier and Mainstream GEM funds at 6, and LATAM at 1. The question was, why is there so little AUM in LATAM? Bob, you talked about how, Argentina and Venezuela were hot a while back. Brazil used to be obviously the darling of Latin America. But Bob, if you want to start, why would you say, from your experience, clients aren't allocating to Latin America, or maybe in your experience they are?
Yeah, I don't know that I have a good answer for that. I think it's because when we structure a portfolio, we're typically, again, going into most liquid to start, and we're going into more of a global frontier fund,
Okay.
where we want everything to begin with.
Sure.
And so that would be the last thing we would do, is take an Asia only or a Latin America fund. So for us, it makes sense. To me, when I look at that data, I say, yeah, that makes sense.
Fair enough. Okay.
I agree with Bob on sort of the allocative structure, but the answer to this question just has to do with the data. This is EPFR data, which is based on mostly mutual fund and publicly available, not just American mutual funds, but European and also other institutions around the world. It's categorizing frontier as literally the names in the countries in the frontier index. So that means it's really only looking at Argentina. So that's a question of how much is in quote-unquote frontier markets around the world, but specifically Argentina relative to everything else. And so it's just a small opportunity set vis-a-vis, Saudi Arabia or Nigeria or the places like that, despite that Argentina is a fairly large percentage of the frontier index. But, when you look at, who's in the other regional buckets, specifically Africa, which has a ton of money into it, not mostly because of the South African pension fund structure that incentivizes people to be in sub-Saharan Africa disproportionate to the rest of the universe, then that's the data answer to that question. But from a top-down allocative perspective, I also agree with Bob.
Fair enough. Gentlemen, this hour has flown by. I would like to thank both Bob and Adam for their participation. It's been a ridiculously interesting webinar. If anyone on the panel didn't get a question answered or has more questions or would like to request the replay or the deck or to connect with Bob or Adam, please email our wonderful PR director, Tiffany Swenson, at tiffany@emia.org, and we'll put you in contact with the right people. Again, Bob, Adam, thank you so much for your participation. We really appreciate it. I think this has been extremely interesting. So everyone in the audience and to our panelists, have a fantastic day, end of your week, and thank you both for being here.
Thank you.
Thank you, Nate. Thank you, Bob.
Sure. Yeah, thank you.